Hello and welcome to this month's Asset Intelligence Market Update. And what a month it's been! The historic success of the England women's football team, the sound and fury of another Conservative leadership contest, Nancy Pelosi's daring visit to Taiwan, and a sweltering two-day heatwave. Things have been well and truly hotting up as we move through summer. Even the markets joined in with a red-hot return of 5.2% from the global stock index in the month of July. But none of that stopped the Bank of England from trying its best to pour a bucket of ice-cold water over things at its latest meeting. The biggest rise in interest rates since the bank gained independence, 0.5%. A warning that price rises will hit 13% in October, and forecasting that a recession will start later this year and continue all the way through 2023. These sound like tough times indeed, understandably ones which might cause investors concern. And this kind of environment is likely to prove challenging for many companies. Nonetheless, here are 4 quick points that we think investors should keep in mind over the months ahead. 1. The capital markets are a big place, and the UK only makes up a relatively small proportion of these. In turn, that means that most diversified portfolios, including those we manage at Asset Intelligence, only hold modest exposure to the country in which we all live. 2. Though interest rates are rising, this isn't back to Black Wednesday in the 1990s. Unlike back then, when rates rose from just under 10% to 12% in a single day, the current rises have been well flagged and expected for months. And of course, with today's base rate at 1.75%, the burden is much lower in absolute terms than it was back then. Plus, the housing market now displays much more resilience when mortgages become more expensive, thanks to growth in the UK's population, coupled with very limited property supply. 3. Not all industries are likely to be as negatively affected as others. Clearly, some sectors, like those reliant on non-essential consumer spending, are likely to see pressure on their earnings as shoppers feel the squeeze. However, others may be better insulated. Banks, for example, tend to benefit from rising rates as profits from lending increase. Similarly, as you've no doubt seen in the headlines, energy companies are helped by high oil and gas prices. Both of these industries and others in the same boat, such as miners, are well represented in the UK market. 4. Finally, investing is not a short-term game. Many companies listed on the UK market have been around for decades. Tesco, for example, was founded in 1919, Rolls-Royce in 1904, and Prudential in 1848. And over those timeframes, who could argue that they haven't all made it through much worse than this and continued to prosper? And there we are. One final thought. John Major famously claimed that his government had handed over a golden economic inheritance to that of Tony Blair. Whether it's Rishi Sunak or Liz Truss who succeeds Boris Johnson next month, one suspects they probably won't feel the same way. More likely, they'll soon be feeling the heat. That's all from me. Feel free to like, comment, share and subscribe, and thank you for watching.